here today, but you're in for a treat. We got a Minnesota Vikings fan over here. Teddy Woodward is the co-founder of Notional, and he's going to be talking about rethinking. Ooh, sorry, I want to make sure I'm right about this. Yes, rethinking DeFi lending, the hidden risks of volatile assets, and the case for pegged asset lending. Big round of applause, please, for Mr. Woodward.
Hey guys, I'm Teddy Woodward. I'm the co-founder of Notional. Notional is a lending protocol on Ethereum that specializes in fixed rates and leveraged yield strategies. Okay, so today wait a minute. It's not on the screen. Okay, all right. Today I'm going to talk about two kinds of lending, volatile asset lending and pegged asset lending. So volatile asset lending is something I think we're all familiar with. It is kind of the OG in DeFi lending. A borrower puts down a volatile asset like Bitcoin or ETH as collateral and then borrows a uncorrelated asset like USDC against that. So volatile asset lending has a really strong track record. It's been around since the beginning, and because of that, DeFi investors tend to think that it's safe and low risk. Pegged asset lending is a little bit newer, and this is when the borrower puts down a yield-bearing asset such as staked ETH and borrows a base token like ETH that's pegged against the collateral asset. Investors tend to think this is a little riskier because it is newer and because the collateral types are more complex and exotic. But I think that is incorrect. And it's not the case that this is riskier than volatile asset lending. The risks are just distinct and different. So I'm going to make a few claims. First is that volatile asset lending is riskier than you think it is, despite its track record. The second is that pegged asset lending is not riskier than volatile asset lending. It just has different risks, and that lenders should diversify and do both. Okay, so let's dive into volatile asset lending. So in this kind of lending, you're primarily focused on market risk. So what you're worried about here is that the value of the borrower's collateral decreases really fast, and then all of a sudden, the borrower's debt is worth more than their collateral, and they're insolvent, and the protocol has bad debt. And the way we mitigate this is liquidation. So this is something that I'm pretty sure everyone is familiar with, but we can give a quick overview. So the way this works is that the collateral value declines, and the borrower becomes under-collateralized. At that point, the liquidator can buy that collateral at a discount, sell it on the market for the borrowed currency, take that borrowed currency, repay the debt, and keep anything left over as profit. Now, the issue with this is something we call the window of opportunity. So in order to liquidate successfully, you have to liquidate after the price has fallen such that the borrower becomes under-collateralized, but before the price falls so much that the borrower becomes insolvent. So in order basically to mitigate the risk for the lending protocol, you have to liquidate within this window. And this window can be quite narrow in terms of price and time. On a bad day, the market can sort of blow through this in the course of a few hours. So really the risk in volatile asset lending is the time constraint that this window of opportunity presents. And the risk you're worried about is that for some reason, liquidations fail during this window when they have to happen. And if that happens, then the protocol is at risk of bad debt. So we're going to go through some reasons why that might happen. But before that, let's just dig into a little bit of the sort of liquidator economics here, because this is important to understand why liquidations might fail. So basically, liquidations are premised on the liquidator making money. And if you want liquidations to happen, it needs to be profitable. And if they're not profitable, then they very well might not happen. So again, here, the liquidator buys the collateral at the Oracle price minus a discount, and then sells the collateral at the market price minus slippage. So their profit margin is the difference between the price they sell it on the market and the price they buy it from the protocol. And their total profit is then the amount they liquidate times the profit margin minus an upfront gas cost. So there's three primary factors that can impact the profitability of liquidations. The first is high gas prices. So gas prices on Ethereum are very correlated to periods of market turbulence and price crashes, which is to say that exactly at the times you need to liquidate are the times you're going to be paying the highest gas prices. So this data comes from earlier this month when ETH went down by 20% in a day, and at this time gas fees spiked up to about 300 gwei. So this means that liquidations are very expensive to do. And when Notional was liquidating through this period, liquidations were costing $400 or $500 each. And so what that means is the liquidator has a very high hurdle rate that they have to make enough money on the discount to cover the upfront cost, which is significant. All right, the second thing that is probably less well known is something I call price divergence. So the issue here is that the liquidation price that the liquidator pays is calculated off of the Oracle price, whereas their sale price is calculated off of the market price. And those two prices are not the same. So during stable market conditions, they track each other pretty closely, but during turbulent market conditions when prices are moving around a lot and gas prices are high and the chain is really congested, they can actually diverge quite a lot. And that's because people are putting trades through DEXs and the market prices are moving around a lot and the Oracle prices are having trouble getting their updates into the chain, and so there can just be a big disconnect. So this chart here kind of demonstrates that. This is ETH Uniswap price data from the ETH DPEG last April. So the blue parts of the line, which are very, very small, are points in time when the market price and the Oracle price were within 1.5% of each other. But the red parts of the line, which is basically the entire line, is when that divergence was greater than 1.5%. So that's most of the time, if not almost all the time. And the reason that matters is you can imagine that if this divergence is 5% and the liquidation discount is 4%, then the liquidator may end up paying a higher price, even including the discount, when they buy the collateral, then they're able to sell it on the market, and so liquidations just won't happen because they're not profitable. Okay, the third and maybe most important thing is liquidity. So the liquidity of many really popular collateral assets in DeFi is actually really thin on chain. So as an example, we've got wrapped ETH here in Aave with about $4 billion, and their total DEX liquidity across all chains is only 75 million. And so that's a really big problem because if you have to liquidate a big chunk, say you had to liquidate $200 million, you would basically be totally unable to do that within a period of a few hours. And once again, this is where the time constraint imposed by the window of opportunity comes into play. Because if you had a week to liquidate, it would be totally fine. But because you might only have a few hours, there's a real risk that you aren't able to do that, and the protocol then faces insolvency. Okay, so to sum up here, basically, high gas prices, price divergence, and low liquidity of collateral assets can lead to unprofitable liquidations and potential liquidation failures during the window of opportunity, which can lead to a potential bad debt accruing to the protocol. So these risks aren't necessarily huge, but they are there and they can never be fully mitigated. So lenders, if you're lending against sort of volatile assets, you need to be aware that you're taking some real risk that will never go away. All right, so let's move into pegged asset lending. So to reiterate, this is the act of lending a base token like ETH or USDC against assets that are pegged to that token, like for example, wrap staked ETH, easy ETH PTs, RSETH, ETH LP tokens. And to be specific, when we're talking about pegged assets, we're talking about redeemability. So specifically, an asset is pegged if there is a redemption path by which you can convert that asset into the base token without trading on the market, right? So like for in the example of staked ETH, it's the simplest example. You just unstake it and you get ETH back, and you'd never need to sell your staked ETH. So you never need to actually interact with the market price. And the same thing exists for all these examples here. Okay. Now this is the key characteristic of pegged asset lending. Because you're able to redeem without ever touching the market, you can be completely insulated from market volatility. Because you know that once you initiate the redemption, you know exactly how much you're going to get at the end of the redemption process. And so that means that any sort of market volatility in between just doesn't matter, right? Because if you have some staked ETH and you unstake it and you get ETH back, it doesn't matter what the price of staked ETH is on the market. And that's really great because it means you don't have to worry about the price of staked ETH tanking. All you have to care about is the integrity of the redemption mechanism. Okay, and to fully take advantage of what makes pegged asset lending special, you kind of need to rethink the way you do liquidation. So traditional liquidations, because they involve the liquidator trading on the market, there's a sort of market price dependency. But the way to sort of fully take advantage of this attribute of pegged asset lending is to do forced redemption instead. So in this, what this is that once the borrower becomes under-collateralized, instead of liquidating, the protocol initiates a forced redemption. So it takes the borrower's collateral and essentially pushes it into the redemption path that will ultimately end up getting the base token back to repay the debt. And it never has to trade on the market, and that's the important thing. So the pro of this is that you're completely insulated from market risk, but the con is that it's more complicated because you have to put the handling of the entire redemption path in the protocol itself. So the protocol has to be able to handle each step along this path to getting the base asset back. So an example of what this would look like, oh, and I'm running out of time here, is so for 1 month RSETH PTs, you initiate the forced redeem, you wait for the PT to expire, take the RSETH, submit the withdrawal request, finalize the withdrawal, collect the ETH, and repay the ETH debt. So it's a multi-step process. So in order for this to work, you have to there's a lot of handling that has to be done on the protocol side. But again, the upside is that you're completely, it allows you to completely circumvent market risk. Okay. So the risk for pegged asset lending, it's not risk-free, even if you can take away the market risk, is the redemption risk. So each asset has a different set of things that can happen that would haircut the redemption value of that asset. So for example, RSETH, it's slashing. SUSDE, maybe you're worried about negative funding risk. SDI, you're worried about the PSM draining. So it's different for each asset, and so is the mitigation. You need to understand all the different things that could happen, think about what the worst case scenario is, and set your risk parameters such that even in that worst case scenario, you can reasonably expect the protocol to not see insolvency. Okay. So to sum everything up here, volatile asset lending has a long track record. It's done really well, but there is this market risk component that is never going to go away. Pegged asset lending is newer, and it has a qualitatively different kind of risk. Now, investors tend to think of risk as a one-dimensional spectrum, and they want to, there's less risk on the left-hand side, most risk on the right-hand side, and they kind of want to be all the way on the left-hand side. But that is fundamentally, I think, the wrong way to think about it. How'd you cut my mic? Come on, man. All right. Anyway, thank you, everybody.
She winks at the moon while that grunge rules over slow motion duel.